Welcome back to the Daily Crypto Roundup. We have got a lot to get through today, and more importantly, all of it connects. Bitcoin moved higher after a softer than expected core inflation print in the United States. But the market is still nowhere near relaxed. Energy prices surged, the wider inflation backdrop is still messy, and crypto is still being pushed around by the same macro forces that have been hanging over markets for weeks now. On top of that, Hong Kong has handed out its first stablecoin licenses. Binance is reportedly offering UAE staff temporary relocation as conflict disrupts one of crypto's biggest regional hubs. CZ is back in the headlines with a memoir that is already reopening old feuds across the industry, and one prominent industry figure is now openly betting against Ethereum on a macro war and oil thesis. So the real theme today is this: crypto keeps trying to trade like the future, but right now it is still stuck dealing with inflation, geopolitics, regulation, and the same old personalities battling to control the narrative. This episode is sponsored by Kraken. If you want a serious platform for buying, selling, and managing crypto, check out Kraken through the link in the description. Let's start with Bitcoin, because the first real push in the market today came from the latest US inflation data. Core CPI for March rose by 0.2%, which was lower than forecast, and that was enough to give Bitcoin a lift. Now that might sound like a small difference, but markets were watching this very closely because core inflation is one of the numbers that matters most when traders are trying to work out how aggressive the Federal Reserve might need to stay. A softer print does not suddenly mean easy money is back, and it does not mean the inflation fight is over, but it does mean traders got something they could work with. Bitcoin reacted the way risk assets often do when the market feels like the inflation pressure underneath the surface may not be as bad as feared. But the catch is that this was not some perfect inflation report. Headline inflation was still pushed higher by energy, and that is where the problem comes in. On the surface, people are still seeing price pressure where it hurts, especially around fuel and transport, and that means the wider economy still does not feel clean or stable. So the market got a split message. Underneath the surface, the inflation picture looked a little better. But in the real world, and in the broader macro picture, it still looked hot enough to keep everyone cautious. That is why Bitcoin rose, but did not exactly explode higher in some huge clean breakout. Traders got a reason to buy, but not a reason to relax. That brings us to one of the most important ideas running through the market today, and it is the point several analysts were making as the session unfolded. Yes, the immediate war premium may have eased a bit in places, and yes, the softer core inflation number gave markets a little breathing room, but the system is still fragile. Institutions do not look fully convinced. Big traders are still hedging. The market still feels like it is stuck between relief and fear. In other words, this is not a confident bull market charging forward on strong conviction. It is a market trying to decide whether the worst of the macro pressure is passing or whether another wave of fear is just around the corner. And that uncertainty matters even more when you look at Ethereum. One of the sharper stories today was the argument that Ethereum is not really trading on Ethereum fundamentals right now at all. Instead, it is being dragged around by oil, conflict risk, inflation expectations, and broader risk appetite. That is why the story around Zhang Joyer opening a medium-term Ethereum short hit the way it did. His case was not really that Ethereum itself is broken. His case was that if the conflict risk around Iran and the Strait of Hormuz keeps energy markets unstable, and if oil stays elevated or volatile, then broader risk assets remain vulnerable. In that kind of setup, Ethereum can get hit regardless of what is happening on-chain. That is the bit people need to understand. Sometimes crypto traders talk as if every move must be explained by something internal to the asset. But that is just not how the market works in periods like this. When macro fear is dominant, Ethereum can be sold because traders are nervous about oil. It can be sold because inflation expectations rise. It can be sold because rates might stay higher for longer. It can be sold because funds simply want less exposure to anything volatile. That is what gives the sub-$2,000 fear angle its power. It is not just a random bearish call. It is a warning that if this turns into a prolonged macro stress environment, Ethereum may not get judged on its own merits. And that leads directly into the next big story, because if you want a real-world example of how geopolitics is still shaping crypto, look at Binance. Reports today said Binance has offered UAE-based staff temporary relocation as the Middle East conflict disrupts the region. Now, Binance also indicated that services remain unaffected, which is important, because you do not want to overstate the operational impact. But the headline still matters. Why? Because it reminds everyone that crypto may be digital, borderless, and online, but the companies, workers, offices, and infrastructure behind it still exist in the real world. And when geopolitical tension rises around a major regional hub, crypto businesses have to react just like anyone else. The UAE has become one of the most important crypto centers anywhere in the world. Exchanges, market makers, founders, funds, service providers, media people, everyone has been clustering there. So when you start seeing stories about staff relocation, even temporary, it tells you that the market is not operating in some separate reality. It is deeply tied into the global system. That is the bigger takeaway here. This is not just a Binance HR story. It is a signal that geopolitical instability can touch the crypto ecosystem at the human and operational level, even when the trading apps keep running and the websites stay online. Now, in a strange way, that story sits alongside another one today that points in almost the opposite direction. While one part of the crypto world is dealing with conflict disruption, another part is moving deeper into formal, regulated, bank-backed adoption. Hong Kong has awarded its first stablecoin licenses, and the names involved tell you everything about the direction of travel. This was not some Wild West rollout led by anonymous startups trying to move fast and break things. This was a bank-first, controlled, institutional move. Hong Kong is showing that when stablecoins move into the next phase, at least in some jurisdictions, they're going to do it through tightly regulated, highly supervised channels with major financial names involved. That matters because stablecoins are no longer just a crypto niche story. For years, people treated them as a side tool for trading, a bridge between tokens, or something that sat in the background. But the next phase looks much bigger than that. Stablecoins increasingly sit at the intersection of payments, settlement, digital cash, tokenized finance, and cross-border money movement. So, when Hong Kong gives its first licenses to players tied to major banking institutions, it is not just approving a product. It is effectively saying that the future of digital money may be built with crypto rails, but under old-world financial supervision. That is the significance. And it also says something bigger about where the industry is splitting. On one side, you have the original crypto ethos of decentralization, disintermediation, and freedom from traditional banking control. On the other side, you have governments, regulators, and large institutions trying to absorb the useful parts of crypto into a system they can monitor, license, and shape. Stablecoins may end up becoming one of the clearest battlegrounds for that split. If the biggest winners in the space become bank-backed, fully licensed issuers operating under strict regulatory frameworks, then the future of stablecoins could look a lot less rebellious and a lot more like digital extensions of the financial system crypto once claimed it wanted to escape. That theme of old crypto ideals colliding with power, narrative, and control also takes us neatly into CZ. He's back in the spotlight with his memoir, and from a content point of view, this is not just a book story, it is a fight over history. The prison writing angle gets attention, of course. The title gets attention. The fact that he says royalties will be donated gets attention. But the real reason this matters is because the memoir appears to reopen old wounds. It throws names back into the conversation. It revisits one of the ugliest eras in crypto. And it immediately triggered pushback, including from figures who say parts of the story are false. That is why this matters beyond gossip. Crypto is still young enough that narrative control matters hugely. The people who shape how the last cycle is remembered can influence who gets trust in the next one. Was Binance the survivor of a brutal era? Was it part of the problem? Was FTX the singular villain? Were there others who escaped proper scrutiny? Who was reckless? Who was clever? Who was opportunistic? And who is now trying to rewrite the story in hindsight? Those battles are still live. And CZ stepping back into the arena with a memoir means he is trying to influence how that era gets remembered. So this is not just personal branding, it is reputation warfare. And when you zoom out, that is what makes today's set of stories so interesting together. You have Bitcoin reacting to inflation. You have Ethereum being discussed through oil and war risk. You have Binance reacting to geopolitical disruption in the real world. You have Hong Kong pulling stablecoins deeper into formal finance. And you have CZ fighting over the past while regulators and institutions shape the future. It is almost like crypto is being pulled in 5 directions at once. Part of it wants to be a macro trade. Part of it wants to be a technological revolution. Part of it is becoming an arm of regulated finance. Part of it is still tangled up in founder drama and unresolved trust issues. And all of that is happening simultaneously. From a market point of view, the biggest practical takeaway is probably this. The market still does not have full conviction. Today's softer core inflation print helped, and that matters. But relief is not the same thing as clarity. Analysts were still making the point that this market remains highly sensitive to oil, highly sensitive to the conflict backdrop, and still prone to violent moves once this tight range finally breaks. So, even when prices look stable for a moment, the underlying tension has not really gone away. A calm chart can still be hiding a very unstable setup underneath. For Bitcoin, that means traders are still looking for signs that macro pressure is easing enough to support a stronger move higher. For Ethereum, it means the asset is still exposed if macro fear builds again. For stablecoins, it means regulation is no longer just coming, it is arriving in structured institutional form. For exchanges and crypto firms, it means location risk and geopolitical risk are now part of operating reality. And for the industry's major personalities, it means the battle over trust, credibility, and legacy is still very much alive. So where does that leave us as we head into the next stretch of trading? It leaves us with a market that got a little help today, but not a full all clear. Bitcoin liked the inflation surprise, but inflation itself is still not fully tamed. Ethereum is still vulnerable to the macro story. Stablecoins are becoming more legitimate, but also more institutional. Binance is showing that geopolitics can hit crypto infrastructure in real time. And CZ is reminding everyone that even when the market moves on, the old fights never really disappear. And before we go, this week's XRP winners are Philip Corse Scott, who gets 10 XRP, and Coy Campbell, who also gets 10 XRP. Congratulations to both. Massive thanks to all of you listening day in and day out that keep this community going. And one more thing, we're also thinking about setting up a Discord for the community, so let us know in the comments if that's something you'd want. Keep dropping comments, keep getting involved, and you could be next. And as always, we will see you at the top.